Hey there, Lincoln here from boacademy.org. Today I want to talk to you about stock dividends and why companies issue them to common shareholders. On this channel, the boacademy.org, we've discussed everything that you need to know to get started investing on the stock market. But now I want to dive deeper into what dividends are and what you stand to gain as a common shareholder who invests in companies that issue dividends. If you don't know what stocks are, or if you don't know how to start investing, we've broken down what stocks are in previous videos, and we even broke down what an IPO is, the initial public offering, so that you can understand what stocks are and how companies issue them as a form of fundraising. So if you haven't seen those videos or you need a refresher, you should go check them out before you continue on this video. And before we get into dividends, I want to ask you a quick favor. If you enjoyed this video, remember to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts below on stocks and dividends and whether or not you're investing in dividend companies. And of course, if you want to support the channel and help us grow, join us over at patreon.boacademy.org. You will get more access to me and get direct answers to your investing questions. And you'll have a chance at winning $200 every month just for being a loyal and engaged patron. And of course, you'll get access to our Discord channel where we discuss investing and share resources to help one another grow our wealth together. Now let's jump in. So what are dividends? Dividends are distributions of earnings that companies pay to their common shareholders just for being shareholders of the company. That's all it is. It's an incentive and a reward for being a shareholder. And these dividends are paid out as a portion of a company's earnings. As a shareholder of a company that pays out dividends, you, a shareholder, are entitled to your share of the dividends based on how many shares you own of the company. A company that distributes dividends will usually pay out a consistent percentage of their earnings to their shareholders. But this amount can change at any time, and in fact, the company is not required to pay out dividends at all. Furthermore, a company can choose when to start paying out dividends at any time, and the company can choose how much of their earnings to pay out as they please. And a company that pays out dividends can cancel their dividend payments at any time, so they can choose to stop paying dividends indefinitely. All of this is up to their board of directors. So you as a shareholder are not entitled to getting paid dividends by a company. The only entitlement that you have in regards to dividends as a shareholder is that you are entitled to your share of dividends that are paid out. So now that we know what dividends are, which companies pay out dividends? Because dividends are paid out from the earnings of a company, usually only companies that have strong cash flows or earnings will pay out dividends. Such companies are those that are well established and have a high likelihood of continuing to earn steady income from their many businesses. Furthermore, those companies are usually no longer focused on high growth of their company. They have shown that they can be consistently profitable and don't need to continue to grow rapidly. So these companies are somewhat in cruise control. That means that you can expect that these companies won't be growing their revenues by much over the years. They will just continue to meet their marks year after year, which is alright because they're done growing. They're just focused on maintaining their position in their market. So that means that you likely won't see any young companies such as Uber or Beyond Meat or Tattoo Chef or even Google or Amazon paying out dividends because they are still in high growth mode. They still want to increase their revenues. They still want to build out new businesses. They are hyper focused on expanding their market share. They want to conquer their markets. So they would not be paying out dividends because they are reinvesting all of their earnings back into the business to capture more market share and build out more products. Some companies that you may have heard of that pay out dividends consistently are AT&T, Intel, Johnson & Johnson, Discover Card, and so many more. These are well-established companies that dominate their markets and aren't particularly focused on growing their market share. They're mostly focused on maintaining their market position. So how often do companies pay out dividends? A company can pay out their dividends as often as they please, but usually it's between every quarter to every year. So a company can pay out their dividends every quarter, or every half year, or every year. That's every 3 months, every 6 months, or every 12 months. Before we continue, let's do a simple example of how much you can expect to earn from dividends as a shareholder of a company that pays out dividends. Say you own 100 shares of a company that pays out dividends. If that company pays out 10 cents per share every time they pay out their dividends, so let's say every year, you would be entitled to $10 every time the company pays out their dividends. That's 100 shares times 10 cents per share. So you will be paid $10 for owning 100 shares of this company that pays out 10 cents per share for their dividends. Now let's discuss dividend yield and how you can calculate it for any company that you want to invest in for their dividends. The dividend yield of a company is simply a metric that tells you how much you can expect a company to pay you in dividends as a percentage of their share price at any given time. Knowing the dividend yield of a company gives you yet another metric to compare them to other companies you want to invest in to figure out which one will yield you the most returns for your investment. Of course, the dividend yield is not the only metric that you should consider when choosing which companies to invest in. The good news here for those of you who don't like math, the dividend yield is usually given to you by your stock brokerage and you don't have to compute it yourself. But it's good to know how to do it. The calculation for the dividend yield is incredibly simple, but you will need to find 2 data points to enter into the formula to figure out what the dividend yield is for any given company at any given time. So the equation is that dividend yield is equal to the annual dividend per share divided by the share price. So how do you find the annual dividend per share for a company? It's pretty simple, but it takes a little bit of work. You will need to find out how many times a year the company has paid out their dividends in the past and how much they've paid out each time. And then add up each of those dividend payments for the last year. And that will give you an idea of how much the company pays out in total in their dividends each year. And then to find the share price to enter into the calculation, you will want to consider the price that you're going to pay to acquire a share of the company. Or if you already invested in the company, you will want to find your average cost per share. For a quick example, say a company pays out a total of $5 per share in dividends per year, and their current share price is $100. If you divide $5 by $100, you get 0.05. That means that the company's annual dividend yield is 5%, which is pretty high. So moving on, there's one thing to consider when you're going to invest in a dividend-paying company. It's not a big deal, but it's worth knowing so that you don't freak out when you don't receive your dividend payment. You need to keep in mind that you must own a company's shares at least a few days before it pays its dividends to shareholders in order to qualify to receive your dividend payment. You may hear this referred to as the ex-dividend date. This is usually a few days before the record date, which is the day of record for which shareholders of the company qualify to receive their dividend payments. And this record date, the date of record, is usually between 1 to 6 weeks before the company pays out their dividends in a given cycle. So with all of that said, how can you expect to receive your dividend payments if you're investing in a dividend-paying company? There are generally 2 options to receive your dividend payments. You can either receive your dividend payments by check in the mail, or you can opt to enroll in a dividend reinvestment plan, which you may hear referred to as DRIP, D-R-I-P. In simplest terms, DRIP is just a way for you to automatically buy more shares of the company using your dividend earnings, and your brokerage can set that up for you easily. Most online brokerages such as Robinhood, Webull, Charles Schwab, TD Ameritrade, they give you the option to automatically reinvest your dividend payments into the same company that you received the dividend payment from. Regardless of how you receive your dividend payments, the IRS, the Internal Revenue System, will consider your dividends as taxable income. Of course, I'm not a CPA, so you should consult your CPA to get more information on how your dividends will be taxed. There's much more to learn about dividends and many more variables to consider when choosing which dividend-paying companies to invest in, or whether to invest in dividend-paying companies at all. We'll cover all of this in future videos, so if you're interested in that, stay tuned. Subscribe to the channel, of course, and like this video. And we will even cover why investing in dividends when you're young and still trying to build your wealth may be a bad strategy for most people. If you're not rich already, and you don't have a lot of money invested in a company or companies that pay out dividends, then investing in those dividend paying companies may be holding you back from building up your wealth faster and more efficiently. That is very important for you to keep in mind when deciding whether to invest in a dividend paying company or a company that's still focused on your growth. Your options are basically between receiving payments from your companies that you're investing in, or investing in companies that are focused on growth and will continue to grow their share price by reinvesting in the growth of the company. So they won't pay you dividends, but they will take that extra money that they earn and put it back into the company and grow the company's revenues, which will translate into a higher share price for the company's stock. And that will increase your wealth. That will build your wealth. So that's the other option when you're deciding which companies to invest in. Personally, I'm still young, I'm still building my wealth, so I don't invest in dividend paying stocks. I don't believe that that's a good idea when you are still not rich. If you have a lot of money, say a couple $100,000s to put into a company, then it might make sense to invest in a dividend paying company because the amount of dividends that they pay you every year is worth it. But if you only have a couple $1,000s to invest in a company, the opportunity cost of investing in a dividend paying company may be way too high to be sensible. You may only stand to earn a couple cents to a couple dollars from the companies that you invest in dividends. That to me is not worth the opportunity cost that I would incur by not investing in a company that doesn't pay dividends, because that company is going to appreciate their share price over time, appreciate their revenues, and I will benefit from the appreciation of the value of that asset. And that appreciation will help me build my wealth even faster and more efficiently than I would if I invested in dividend paying stocks. So this is very important to keep in mind. So I hope this has helped you understand dividends and what you stand to gain from investing in those companies that pay out dividends to their common shareholders. And I also hope it gave you an idea of why it may not be the best investment strategy for everyone, especially those who are young and still building their wealth. So if you enjoyed this video, like the video below, subscribe to the channel, hit the notification bell, and comment below what your thoughts are on dividends and whether or not you're taking the dividend investment strategy. And if you would like to support the channel and help us reach more investors, then join us over at patreon.boacademy.org. You'll get more access to me and get direct answers to your investing questions, and you will have a chance at winning $200 every month just for being a loyal and engaged patron. And of course, you will have access to our Discord channel where we share investment ideas and resources to help one another build our wealth over the long term. So if you're interested in all of that, I hope to see you over at patreon.boacademy.org. I'm Lincoln with boacademy.org. Thank you again and have a great day.